Hello and welcome to another video of our knowledge base. This one is called Trends and Moving Averages. And in this video, I'm going to talk about how to recognize trends, what trends are, and why do we actually need them. I know many people already asked me why exactly do I need to be able to have a daily bias, to have the the skill to read trends across different time frames? And the answer is actually pretty simple. There's only two ways you can set up your trade. Only two main ideas. You can either bet on continuation. This means I go long in an upwards trend. Or in this case, I could also go short in a downwards trend, of course. Or I bet on mean reversion. This means price goes up and I bet on the price at a specific point to reverse, and after this upwards trend I bet on a mean reversion and I go short. These are the two only options you can have when thinking about how to set up a trade. Will I trade the continuation, or will I trade mean reversion, which means will I trade against the trend? And this is why we need to be able to recognize trends. It's very, very important that we find ways to recognize trends, to mark them out, and to have a clean idea where these trends might end or might continue. So this is what I'm going to do in this video, and let's jump into this right now. So there's basically only three ways of watching the market. You can have an uptrend. An uptrend means we have continuously higher prices. Price continues to go higher. This can go over days, over weeks, over months, depending on the time frame you're watching. We can have downtrends. This is, of course, exactly the other way around. Price comes from a high point and continues to move lower. Very simple so far. We're not going into details. Just understand an uptrend is a continuously higher moving price, and the downtrend is exactly the opposite. As a third option, we have sideways moves. Some people call them choppy moves, or basically choppy moves or sideways moves. This is when there's no clear trend. Price goes up and down again and up and down again, but we move within a specific range. Some people call it the range plays. However you want to call it, doesn't really matter. The idea here is that we have no clean trend. Whenever we think we're going higher, price reverses, revisits the lower area of that range, and whenever we think we go lower, price bounces and revisits the higher range here. So these are the three ideas about trends there are. There's not much more. However, what we need to be very aware of, these trends and the way we look at trends depend on the time frame. While this, for example, this is a 4-hour chart, we all see this is a very, very clean downwards trend with continuously lower highs and lower lows around here and around here. Very simple. However, if I were to trade the 15 minutes, not the 4-hour chart, and I would zoom in, I would see something like this. If I zoom in exactly at this point, this looks like an uptrend. So if I'm looking for my trade setups on a 15-minute time frame, this could be the uptrend I'm playing. For example, here is a nice resistance level, and I could play to take the breakout, to go long in this case. However, I need to be aware of the higher time frame that I will run into resistance very simple or very easily once I reach these specific ranges of my higher time frame trend. So there is not the one single trend. There's not the one single time frame. I could switch to a daily chart now, or to a weekly, or even to a monthly chart. And in many cases, every time we switch the time frame, we have a completely different picture. So whatever you trade, be very aware of the time frame you're trading, but also be aware of the support and resistance levels you might run into on the higher time frames. So always, and this is what I usually say, always see the context. We can never take a trade which is completely out of context. There's always a higher time frame context, or a context around the entire market. So be very, very aware of that. And now we need to see that every trend has different implications for whatever our trading setup or trading strategy might be. In an uptrend, for example, in general, it's easier to go long. Why? Because I'm betting on continuation. I'm seeing that price continues to go up over a long period of time. Here and here and here and here, depending on my time frame, of course. So the probability of a continuation is just higher. In this case, it's absolutely logical that resistances like here or there tend to break. And on the other hand, that support tends to hold. Whenever price moves back or pulls back like here, here's a potential support area. Here we see that, and we bounce off support. Here we pull back again, potential support. We bounce off support and continue. So this uptrend has a very clear implication. The same goes for the downtrend. Again, as I said in the beginning, in this case, usually we're betting on continuation. Yes, of course, there are ideas and there are trading styles where I bet on specific points to be reversal points. Like down here, it's absolutely possible that we break to the upside, break structure here, and establish a new sort of trend. Yes, but right now the trend is your friend. Especially when we see that the trend has been holding for quite a while, depending on your time frame again, then I would want to bet on continuation. In this case, again, we have lower highs, lower lows, lower high, lower low. So in this case, it's exactly the other way around. Resistances, like here, when we come from down here, touch resistance up here, they tend to hold. And support levels tend to break. Of course, support usually helps us for price to bounce from a lower level into higher ranges. Here in this case, we're in a downtrend, so support breaks and we continue to go down. When we have sideways action, this is a little bit different. When we have sideways action, we usually move within ranges. Like here, up here is a range, or let's just say the resistance of the range, the higher area of the range, and here's the support, the lower area of the range. In these cases, we bet on the resistances to hold and on the supports to hold. Because this is exactly what we're betting on in a sideways move. We assume that we will stay within this ranging environment or choppy environment, and for this to be true, resistance needs to hold and support needs to hold. So every time we reach that upper line, we could go short, and every time we reach the lower area, the discount area, we could go long. These are the ideas around the three different market structures we can observe. How can we actually read trends? So the first thing I already mentioned when talking about this, we can read market structure. Market structure is represented and displayed by a specific continuation, by a specific structure of highs and lows. In this case, in an uptrend, we just have higher highs and higher lows. The low point is here. The next high point breaks this one, so a higher high. The next low point is higher, higher high, higher low, higher high. This is one way of just reading structure and of reading trends. Now there's another way. Many people love to use trend lines. And here we have to be very aware of the fact that it doesn't really matter how we read the market and how we read the trends. It just gives us different implications for our trading. For example, when I'm working with higher highs and higher lows, I'm more focused on the price action within the chart, and I will be very keen on finding the key support and key resistance levels where price is bouncing from or where price is breaking through, and find entries and ways to trade this. When I use trend lines, I just have a different point of reference, because when people use trend lines for their trading, they usually trade the trend lines. For example, going long every time we touch the lower part of the trend line, or breaking this trend to the downside, which would mean going short. We could easily just break through this, get a retest, and then people would go short. So what sort of trend you're reading and how you read this heavily depends on your trading style. The third way of seeing this is moving averages. Of course, there's more ways, but this is the basic approach. And a moving average is more dynamic. A moving average doesn't give you a fixed line or a fixed point. A moving average takes the average price out of a past set of candles and just calculates the average. And this is being put together in form of a line. So if, for example, if you have the SMA, the simple moving average 50, this just means this line creates values every time out of the last 50 candles, creates an average and sets a point. And these points will change, of course, because every time we will consider different 50 candles, a different set. And this is why the average changes. And this is why, of course, consequently, the line changes. And even here, there are people using these lines for confluence. Hey, is this something I'm looking at, but I'm not actively trading? And there are traders who are actively trading the lines. Like here, there is a strategy where you can actually trade the breakdown below this moving average. Saying, okay, the minute I have a candle close, maybe a 15-minute or an hourly candle close, depending on the time frame you're using, the second I get a candle close below that, I will go short, because this is for me the proof that the trend is not holding anymore. Now let's jump into some real-life examples from Bitcoin. This is the 4-hour chart, and I just want to show you how what we just talked about can actually be made tangible and usable. For example, we start with this area. We see a very, very long sideways move. And as I just said before, these sideways moves allow us to assume, hey, if we are in a range, we assume the resistances to hold and the support levels to hold. So what is it that happens here? We see how every time we touch these extremes or the ranges, we actually bounce towards the other side. We come down here, here is a touch, and what we do is we go all the way up towards the other side. Yeah, here's a deviation. You will see that we never really have the price doing exactly what we want. And whenever we don't see exactly what we want, we see these deviations. Here, price ranges above our zone, our range in general, but then breaks back down here and revisits the other side. Another quick deviation, price comes up, almost touches this one, goes back, up, down, up, down. So this means every time we touch this zone once, twice, 3 times, or to the upside once, twice, 3 times, we could have gone into the other direction, applying a mean reversion trade. And this can be very, very profitable, depending on your strategy. Whatever your strategy later is, this is something that's important. Define the range and play the extremes of the range, the support levels and the resistance levels. But what we also see is that the range starts to break. Here, for example, we have a low point, we have a higher high, a higher low, and while we're still moving within this range, we are establishing an uptrend. Higher high, higher low, higher high, higher low, and so on. It doesn't really stop, it just changes its character. While it's here a little bit flatter, it turns into a steeper range, a real price explosion. So we established the trend. We saw that from a ranging sideways environment, we moved towards an increasing price. So an upward trend, a trending environment. So we can actually trade that. If we combine these ideas of the trend with the previous session about support and resistance, it's not that difficult. So we see here we already hit a higher high and a higher low. So what we can assume, hey, maybe this range now will break. So we assume for this resistance point to break to the upside. Let's make this black, which would be a little bit easier to see. There we go. So a totally valid idea is, hey, maybe we break this to the upside. And we actually do. We break to the upside, we see the retest, and we continue higher, another higher high, another higher low, and continuation. And this is what we can play all the way long. Here again, resistance level, which has been built by the former high, we play the breakout. We break above the level and continue. And this can be done all across the board. Whenever you see how the structure is forming, you can just, in upwards trends, you can just assume or bet on the resistance to break. And the same, of course, goes for the downtrend. A very simple idea. So let's just remove these. Let's see where we get a downtrend. You see, we move through the time and have another strong sideways move for a long time. Here, forming a range again. And now we're going down. This is not as long and not as explosive, but this is still a down move. So what we see here, the same. We have our high point, lower high, lower high, lower low, lower low. So we start, and you could draw the trend line here, we start seeing a downtrend. So this is exactly the other way around. We just watch and look for specific support levels that might break. And if we remember correctly, in a downtrend, the support is more likely to break. Of course, we play continuation. And here is a support level. We could even draw this back here. Yeah, we see it's choppy, we have a lot of wicks, but it's still a very valid support level. And what happens is we approach that level, test, 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 break through, deviation, have another retest, and then we break down. So playing this breakdown can be a very profitable trade. Why? Because you are in the, you develop the skills to see exactly what sort of market environment you're in. This is a very, very choppy environment, and we see how we break down massively only to come back up massively. We retest that level. Formerly it was a support level. Now it turned into resistance, and we go back down, back up, back down. But we still remain in this downtrend. We still set higher, lower highs and lower lows. So in this trend, it's just more profitable to trade the continuation, meaning we will have more downside until we see the next move, until we see the next accumulation, which is shown here by this range. And again, next range, support holds, resistance holds, besides these deviations, and we put in a local bottom and go up again. And here we can play the whole thing again. Where's the resistance? Where's the support? In this case, here's a resistance level. We accumulate below it, break out. We're still in an uptrend. Here's the resistance level. We pull back a little bit, accumulate below, and break out. And a third time, here again, we build the highs. Here are our high points. We start accumulating, we fake above it, we break back below, and then we continue. And this is exactly the way you will be able to identify trends, see where we go up, see where we go down, adjust this with your current market bias, adjust this with your current trading style and time frame, and you will be able to play these moves very, very profitably.